An annuity is an insurance product that can help you turn savings into an income stream and make your financial plans during retirement more predictable. An annuity is a contract between you and an insurance company. You make a lump sum payment or give the carrier a series of payments, and in return, you obtain regular payments at some point in the future. The goal of an annuity is to secure a steady stream of supplementary income into retirement, and guarantees are based on the financial strength and claims paying ability of the insurance company. Annuities are complex products, and it's important to understand the balance between all of their features and factors. Common benefits of an annuity include building your retirement savings on a tax-deferred basis, catching up on your retirement savings through contributions not subject to the IRS annual limits of an IRA, earning interest on your retirement nest egg, leaving a legacy for your loved ones, and receiving guaranteed income payments for the rest of your life. Annuities are designed for long-term financial planning. You can withdraw money from your annuity at any time. However, there may be withdrawal charges and fees that apply. Withdrawals will reduce death benefits and account values. In addition, withdrawals made before the age of 59.5 may be subject to a 10% federal income tax penalty. Your insurance carrier will provide you with an annual statement after each contract anniversary. The annual statement will show you the amount of any interest, withdrawals, fees, contract values, and other important information about your annuity and its benefits as of the anniversary date. Annuities can vary greatly based on the features of the particular contract you choose. A fixed annuity earns a guaranteed interest rate for a specified period of time. Other types of annuities, such as fixed indexed annuities, offer different options. To learn more about those, take our course on fixed indexed annuities. To learn more about fixed annuities, watch our next section. But first, test your knowledge with a quick one-question quiz. A fixed annuity is an accumulation product offered by an insurance company that is tax-deferred as long as the money used is non-qualified. Fixed annuities provide a guaranteed rate of interest for a specific period of time, which may appeal to individuals with a low risk tolerance and those who want certainty about what rate they can earn for a period of time. A MYGA, or multi-year guaranteed annuity, is a type of fixed annuity that guarantees a rate of interest, generally for 3 to 10 years at a time. A MYGA offers a fixed interest rate similar to a bank certificate of deposit or bank CD for a specific period of time. Though similar in that they offer a fixed rate for a certain period of time, annuities and CDs differ in many ways. Specifically, annuities are backed by the financial strength of the insurer, and bank CDs are insured by the FDIC. In addition, with respect to withdrawals, fixed annuities have a surrender charge schedule that can cost you a portion of your principal, whereas bank CD penalties cost you a portion of your interest. MYGAs are a type of insurance product. They are long-term contracts that can be used to generate a guaranteed income that cannot be outlived. MYGAs can also offer a competitive interest rate for a set period of years and may also apply a charge on early or excessive withdrawals. If you purchase a MYGA, the insurance carrier will typically pay you interest on your premium payment each year for a guaranteed interest period. You can usually withdraw the interest each year. Like other annuities, you can also choose to receive a guaranteed stream of income at a maturity date. So what happens when the guaranteed interest period ends on a MYGA? Watch the next section to find out. But first, test your knowledge with a quick one-question quiz.
Fixed annuities have defined guaranteed interest periods. During the guaranteed interest period, the insurance company will credit a guaranteed rate of interest on your contract value for a set period of time. Insurance companies typically offer guaranteed interest periods between 3 and 10 years, but some offer many more options. At the end of the guaranteed interest period, you usually have the flexibility to continue for another guaranteed interest period of the same length or choose a new guaranteed interest period of a different length. The interest rate for the new guaranteed interest period will likely change from the interest rate credited during the prior guaranteed interest period. However, the interest rate will never be less than the minimum interest rate guaranteed by your contract. At the end of each guaranteed interest period, the carrier will declare new interest rates for each new guaranteed interest period. People sometimes call these renewal rates. At renewal, the insurance company will usually automatically renew your annuity for the same length of guaranteed interest period at the then current interest rate, unless you instruct them to do them otherwise. If you would prefer to withdraw some of your money or all of your contract value at the end of any guaranteed interest period, you generally have a 30-day window to do so, free of any surrender charge or market value adjustment. Can you change your mind about purchasing a fixed annuity and get your money back? Watch the next section to find out. But first, test your knowledge with a quick one-question quiz.
Depending on the state you live in, after purchase, you will have between a 10 and 45-day period, with some limited exceptions, known as the free look period, to further review your financial decision and ensure it's the best option. If you decide to change your mind during this period, you can return the contract and receive a complete refund without penalty. Once the free look period expires, any withdrawal in excess of what the contract permits will generally be subject to penalties, such as surrender charges and market value adjustment. Now that you've decided to keep the MYGA, how can you withdraw money from the contract? Watch the next section to find out. But first, test your knowledge with a quick one-question quiz.
Annuities are designed to be long-term savings vehicles, and liquidity needs should be considered prior to purchase. Life is full of surprises, and you may need or want to access the money in your account earlier than expected. You can withdraw money from your annuity at any time. It's important to note, however, that withdrawing money from your annuity early may result in surrender charges, a negative or positive market value adjustment, prorated fees, or less interest credited to your contract. Please note that surrender charges are not a part of or associated with the IRS taxes or penalties that may accompany a withdrawal. Surrender charges are in addition to any IRS liabilities. You may take a portion of money out of your annuity. We call this a withdrawal. If you withdraw all the money in your annuity, we call this a full surrender. The amount that you receive upon full surrender is known as the cash surrender value and is net of these charges and adjustments. The money available from your annuity as a full surrender, as a death benefit, or upon annuitization will never be less than the guaranteed amount described in your contract. The amount may be less than your premiums paid. What does it mean to incur surrender charges? We'll explain that in the next section. But first, let's test your knowledge with a quick one-question quiz. While you are encouraged to avoid withdrawals until your annuity has completed its surrender period, withdrawals are permitted under certain circumstances without incurring a surrender charge. Surrender charges are assessed if you choose to take a withdrawal in excess of any free withdrawal amount allowed under your contract. The free withdrawal amount is generally an amount you may take from your annuity contract each year without incurring any charges or adjustments. Surrender charges are typically expressed as a percentage of your premium or contract value. In general, surrender charges apply to an annuity for a certain number of years after issue or the date of the premium payment, such as 5 or 10 years. This is known as the surrender charge period. On a MYGA contract, a new surrender charge period may begin when entering a new guaranteed interest period. What if interest rates have changed dramatically when I go to withdraw money from my account? We'll explain how current market conditions can affect how much money you can withdraw in the next section. But first, let's test your knowledge with a quick one-question quiz.
Many annuity contracts contain an adjustment for changes in market conditions that applies when you withdraw money. A market value adjustment, or MVA, is an increase or decrease in the amount of money you receive when you take a withdrawal in excess of the free withdrawal amount or fully surrender your contract. The free withdrawal amount is typically a percentage of the contract value that you may take each contract year without incurring any charges or adjustments. On a multi-year guaranteed annuity, an MVA typically applies during each guaranteed interest period and is applied in addition to any surrender charges. Most insurance companies waive the MVA when death benefits are paid or when you annuitize your contract. However, in the MYGA market, some products do not have a free withdrawal amount. Others allow for withdrawals of only the interest, and others allow a certain percentage each year, such as 5 or 10%. It's important to review and fully understand the specific details of your contract to understand how your MYGA operates. An interest rate, treasury rate, or index performance may be used to determine the value of the MVA and is described in your contract. In general, if rates are lower at the time of withdrawal than they were at the date the contract was issued, then the MVA will be positive. This results in an increase to the dollar amount withdrawn. If rates are higher at the end of time of withdrawal than they were the day the contract was issued, then the MVA will be negative. This will result in a decrease to the dollar amount withdrawn. The amount of the MVA is limited so that the amount of money you would receive upon full surrender is never less than the guaranteed amount described in your contract. Likewise, the amount of MVA that would be added is generally limited by the same amount. Are there any ways you can withdraw money without any type of penalty? Yes, there are. We'll cover them in the next section, but first, test your knowledge with a quick one-question quiz. Insurance companies have a number of different provisions that allow for withdrawal without penalty. You should read your provisions in your contract to be certain of the specific circumstances. There are a few common options to withdraw without a penalty, including any amount permitted under the annual free withdrawal amount benefit, a required minimum distribution requested after the first calendar year, income benefits provided by lifetime income rider, and by annuitizing your contract. Additionally, a multi-year guaranteed annuity may allow you to withdraw your contract value without penalty for a period of time once the guaranteed interest period ends. This period is typically 30 days. When you reach the age of 72, the IRS requires that you start taking distributions from your tax-deferred savings plans. How does that happen if you own an annuity? We'll cover that in the next section. But first, test your knowledge in a quick one-question quiz.
If you have a tax-deferred savings plan, you should consider how required minimum distributions, or RMDs, fit into your retirement withdrawal strategy. That's because upon reaching age 72, the IRS requires that you withdraw at least a minimum amount each year from amongst your IRAs and retirement plans, except Roth IRAs, and that you pay ordinary income taxes on the taxable portion of your withdrawal. The amount you must withdraw depends on the total across all your tax-deferred savings plans. However, you can choose whether you want to take the full minimum required distribution from a single retirement account or from multiple retirement accounts. The tax rules that apply to annuity contracts are complex. Individuals should seek independent tax advice based on their own circumstances. The company does not offer, and this information is not legal or tax advice. Please consult with a qualified attorney or accountant prior to making informed purchase decisions. Each year, your insurance carrier will provide you with an estimate of the RMD you must withdraw based on the contract value and any rider benefits provided by your specific annuity. Most insurance companies provide an option for systematic withdrawal of the RMD amount from your annuity. Now, how do you set up your annuity to start giving you regular payments? We'll cover that in the next section, but first, let's test your knowledge with a quick one-question quiz.
Generally, annuities offer 3 different methods to convert the contract value into income: traditional annuitization, systematic withdrawals, and the election of guaranteed income riders. Guaranteed income riders are not commonly offered on MYGAs. All annuities can be annuitized, meaning they can be converted into periodic income payments. Annuitizing generally provides the highest lifetime income amount out of these 3 methods. In exchange for this higher benefit, the contract will generally no longer have any cash surrender value once you annuitize. The earlier you annuitize and the more beneficiaries who receive the annuity benefits you have, the lower the periodic amount paid out will be. Some annuities may specify the date that the contract can be annuitized, while others may have a flexible date. Different annuity payment options may be available, such as lifetime payments or payments for a certain period of time. You can also set up systematic withdrawals. With this method, you choose the amount and the number of payments you want to receive. This method does not include a guarantee that it will last your entire lifetime. It is entirely dependent on the amount of money in your annuity, and the payments stop once the contract value has been depleted. This method can be used to set up systematic withdrawals of required minimum distributions. Finally, you may be able to elect a rider that guarantees a specific amount of income for your entire lifetime, even if your contract value has depleted. In general, you may start receiving your income benefit at any time. However, some riders may only provide an income benefit once you've reached a certain age or your contract has passed a certain anniversary. There may be additional fees for this rider. Now you understand the various ways to take money out of your annuity. But how can you pass on the money to your heirs? We'll cover that in the next section. But first, let's test your knowledge with a quick one-question quiz.
You can leave a legacy for your loved ones with a fixed annuity. You determine who receives the death benefit by designating beneficiaries when you purchase the contract. That person or persons, who could be a spouse, a child, or other loved one, will be able to receive benefits after you die. In general, the death benefit is equal to the greater of the contract value or the guaranteed value described in your contract. This means generally no surrender charge or market value adjustment will apply. What happens if your spouse needs access to the interest or cash value after you die? We'll explain how this is handled in the next section. But first, test your knowledge with a quick one-question quiz.
If your spouse is designated as the beneficiary and you were to pass away, your spouse can continue the contract as the new owner in lieu of receiving the death benefit. The Internal Revenue Code has distribution at death requirements that may affect the terms of the contract upon spousal continuation. These are described in your annuity contract and are based on the death of the owner unless the contract is owned by a trust. Let's test your knowledge with a final, quick, one-question quiz.